Good morning, good evening, good afternoon, wherever you're at. Thank you for tapping in. I am your host, Stubby, and this again is Play by Play episode number 2, numero dos. Again, this is not financial advice. Do your own research. This is for educational purposes only. I appreciate you for tapping in on the journey. But again, like, comment, and subscribe for more content, and join the Telegram using this QR code. So today I'm going to be going over my 5 investment laws. I repeat, my 5 investment laws. There's a reason why I have 5 investment laws. I feel like, anybody that sets out on a journey and embarks on any sort of task should have some foundational principles that they stand on. If you can't stand on anything, then you may accidentally fall for anything. So law number 1, understand that trading and investing are not the same. I repeat, trading and investing are not the same. There's various types of trading, of course, but in a broad stroke, you're buying at a certain price point to sell at a certain price point, as opposed to investing would be with the objective of buying to grow wealth over a time frame, to accrue and accumulate wealth, whatever it is that you end up acquiring. So rule number 1 again is going to be understand that investing and trading are not the same. If you're going to invest, have an investment account. If you're going to trade, have a trading account. Separate the two. Don't combine them, because you might get your face ripped off. That's what leads us into rule number 2, law number 2. Know what you buy. It's very important to understand what you're deploying your capital into, where you're putting your dollars at, what they're doing, what they're working for. If you trade without understanding technical analysis and how to perceive macro indicators in the real world, for example, right now there's the Federal Reserve, and they have their meetings in which they're currently doing rate hikes at the time of recording. The last rate hike was 50. Prior to that, it was 75 consecutively. Because they lowered it, we recently saw a rally. That's a macro indicator. Of course, there were also a couple of various factors like short squeezes on Bitcoin, because people anticipated it to continue to go below 15,000. A lot of people were calling for a $12,000 Bitcoin, but if you don't know how to perceive macro indicators, you will get your face ripped off. People may potentially say the Federal Reserve is not going to raise interest rates by 50 basis points. They're going to raise it by 25 basis points. That is a bullish insinuation or a bullish speculation. So people are anticipating that to happen. It's priced into the market for them to raise rates by 25 business points. What happens if they raise rates by 50 basis points? We're going to see a whole lot of red. That's because that's not priced in, and that's just a macro indicator that you must take into consideration. Again, know what you buy. If you trade without understanding what you're doing, technical analysis and macro indicators, you're going to get your face ripped off. With investing, of course, it's very important to know what you buy, of course, but you don't necessarily have to be as keen on technical analysis when you're investing, because it's more so of a long-term play. You're not buying in to look to sell next week. You're not buying in to look to sell next month. You may not even be looking to sell at all. Some people invest so that they may particularly borrow against their investment and never actually sell their particular investment. Rule number 3 is going to be strategy over emotion. You must remember, as an investor, not to invest with emotion, but with strategy. If you see that, okay, there's a massive rally in the market. Bitcoin just went from 16,500 to 23,000. Oh, it's over. Be no more red. Bitcoin's going up to 100,000. Let me buy right now immediately because I have FOMO, fear of missing out. That's emotion. Fear is a form of emotion. So ultimately, you must maintain your strategy and understanding that, okay, if I said I'm going to buy $50 of this currency per day or this stock per day, dollar cost averaging, I'm going to stick to that plan. And if it goes up, I'm going to accept gains with it going up because I continue to dollar cost average. But I'm not going to do anything out of character. The 4th rule or the 4th law is going to be, when the average person is looking in one direction, it's usually appropriate to look the opposite direction and weigh the risks of taking that path. When everybody's saying, okay, Bitcoin to 100,000, Bitcoin to 1,000,000. At the peak of the last bull run, when Bitcoin was at 65, 66,000, people were saying, oh, Bitcoin's going to 100,000 next stop 100,000. When everybody was looking in that direction, you couldn't find a bear in sight. You couldn't find somebody saying, oh, it's about to crash. But if you were to have taken the common sentiment at that point in time and looked the opposite direction and said, okay, I bought Bitcoin at 30,000, now it's at 60,000, I've doubled my investment. Everybody's continuously saying it's going to go to 100,000. It's not a utopia. So if I sell and I take my profits now, what are the risks of actually doing that? Well, if you would have sold at 65,000 or 66,000, you would have been probably one of the best timed sellers within the switch from the bull run to now, which is the bottom of the bear market. Ultimately, number 4 is going to be when the average person is looking in one way, make sure that you look in the opposite direction and weigh the risks associated with going in that direction. Does not mean you go that direction by any means, but take a look and consider what going in that direction would do for you or what it would mean for your particular position. Rule number 5, the last of the 5, be patient. Be patient. And it all ties back into rule number 3, law number 3. There will be fear and there will be greed in the market. There's going to be rallies where people just want more and more money, so they're just deploying more and more capital, and all you're seeing is green candles and green wicks. There's also going to be fear in which people are continuously saying, it's over, it's going to crash, it's a terrible investment, don't put your money in this asset at all. That's what would cause crashes, that's what causes dips. Of course, there are some shit coins out there that will go to zero. I firmly believe that 90 to 95% of cryptocurrencies that are currently in circulation will go to zero, but that would be for a different video. So again, rule number 5, law number 5, be patient. There will be fear, there will be greed, but it ties back to rule number 3, strategy over emotion. One dime I do want to drop you all off with is that statistically, more than on average, those who dollar cost average into the market see better returns over time than those who attempt to time the market. Which means if I say I'm going to buy $200 worth of this coin every 2 weeks, or $200 worth of this stock, or $200 worth of this index every 2 weeks, I'm more than likely over a 4-year time frame or a 1-year time frame, even maybe even a 6-month time frame, I'm more than likely going to see better returns than the person who said, okay, I'm not going to buy it right now or next week, I'm going to buy it when it gets to this specific price point. Dollar cost averaging over trying to time the market. If you're not a trader, there's no use in trying to time the market. You're going to get your face ripped off. But again, this is not financial advice. Thank you for tapping in to Play by Play episode 2, where we broke down my 5 laws, my 5 rules of investing. Join the Telegram using this QR code or the link below, and like, comment, and subscribe for more content. I appreciate you for being here on the journey. Next week, we buy back into the market. Peace.